Welcome to Behavioral Finance and FinTech. This is the second week of our discussion, and here we're going to talk about why do we care about efficient market hypothesis. We're going to refresh our memories and set up our solid understanding of efficient market hypothesis in this part of my lecture. Then we'll move down to why do we care about EMH, right? This is because EMH is a centerpiece of neoclassical economics, right? What we mean by efficient market hypothesis, you may roughly remember, maybe, or most of you must have forgotten this, even though you must have learned it in your financial management class. What was that? Just like Dory turning around after vacation, you're like, hello, right? Why? Because perhaps you blindly memorized everything and then after, vacation, it's over. But you want to remember it throughout your life. Yeah. And some of you may remember that, efficient market hypothesis, those information is reflected in the price. I know that, yeah. And then the forms of efficient market hypothesis, weak form, semi-strong form, strong form, EMH is there. But there is something more to it, okay? There's something more to it that we need to digest it fundamentally, right? Let me take you to this question, price versus value. How are they different? In what respect are they different? Okay? So for example, price of, Price of Tesla, okay? Is it observable or not? And value of Tesla, is it observable or not? Okay? Objectively observable or not, should I say? Okay? Price, it is observable every millisecond. Not just a second these days, every millisecond. You can see it, right? In Google Finance or investing.com, you can see it. Value, the fundamental value, right? True value of it. 적정주가 in Korean terminology. Is that something observable in objective manner, or is it something you just estimated in subjective manner? The latter, right? It's not observable. You are just estimating in the dark. Oh, yeah. Just like blinds touching the elephants. Oh, the elephant looks like a trunk or something, like a pillar. Value is similar. True value of Tesla, good luck, man, if you can observe it. If everybody can observe the true value of everything, like a crystal ball, right? Then the whole profession of finance would have disappeared. No need, right? But because it is not observable, we make money out of it, okay? And what are the two channels of value? Well, let me draw the diagram or the formula over here, right? Price versus value, okay? And then value, how would you estimate it? Well, in rough manner, future cash flow, and today, true value, okay? Future cash flow, you discount it at the relevant cost of capital, right? This is Finance 101. And then, it's like a summation of T equals 1 to infinity, cash flow that you expect, 1 plus R to the power of T. You can see it, right? But if the cash flow is expected to grow at the slow rate, right, stable growth rate, then it summarizes down to this one, okay? And then, so the true value of your company, right, or the stock or any asset, how does it get affected? Or what are the true two different channels that affect the value? Two channels. The first channel is cash flow. How would you expect the cash flow to grow, or what would it be like that, right? The second channel is the risk. Okay, if the cash flow is going to be risky, more volatile, then you are more risk averse, so that your relevant cost of capital will be higher, which means your denominator is bigger, so that your true value will be smaller, will go down, right? The inverse relation happens, right? Inverse relation. If your cash flow expectation is bigger, it goes up, then the true value estimate will go up, going to the same direction, right? So those two are the two different channels of value. Now, the question is, efficient market hypothesis, is this price being equal to true value, the fundamental value, is it or not? Is our question. The thing is, this thing is visible, observable, right? So yes. The thing is, this guy is not observable. You cannot observe this guy. Scientifically, to test whether the left-hand side of the equation equals to the right-hand side of the equation, then you should be able to observe both of them. But the trouble is, you cannot observe the right-hand side of it, the equation. Then how could you scientifically test it? Is a really challenging question. Okay? And the efficient market hypothesis says that it should be equal. Eh? Can you test it scientifically? Not really, because of the unobservability. If you could observe it and you can test it and then prove it, then the efficient market will be a theory based on solid scientific test. But we don't call it efficient market theory. It is just a hypothesis. Why is it called a hypothesis? Because this is not observable. No scientific testing can be possible. We are just indirectly testing it. Okay? So efficient market hypothesis, we can still use it. You still use it, and we still believe it religiously if you are a neoclassical economist. Okay? So let's go. Now, efficient market hypothesis developed right in 1960s. Economists were putting finishing touches on theory of competitive markets, right? If you remember economics 101, right? Perfect competition market. You're the price taker, and then those information, you just, it's available, it's reflected in the market, in the price, and then, everything will work out nicely. The invisible hand will take care of the resource allocation, right? Bringing it to financial market, the finishing touch had to do with this kind of, this efficient market hypothesis was emerging, right, like this. And then emerging intuition is that the perfectly competitive market, there is no free lunch, If you remember economics 101, the market participants of the perfect competition market, there's no profit, marginal profit, zero, right? It's the equivalent idea. Securities market seemed to approximate the theoretically perfectly competitive market. Okay? And then EMH definition, Eugene Fama, in his famous 1970 paper, he said it like this. This leads to natural leader, right? An efficient capital market is a market that is efficient in processing information. The prices of securities observed at any time are based on correct evaluation of all information available at the time. In an efficient market, prices fully reflect available information, right? And the thing is that in everyday language discussion, he says it this way: the price moves as if it reflects all the information in the market. As if, right? 뭐뭐 한 듯이. That's a critically important part. Okay? The efficient market hypothesis, it is the hypothesis that real capital markets actually are efficient by Fama's definition that you saw before over here. Okay? Then in mathematics, EMH's assertion that price is equal to true value, which is expected value of true, P star, which is true value or fundamental value. Expected value is the fundamental value, the present value of all cash flows that investors rationally expect to receive. Then you see this mathematical formula like this. You can just replace this guy with V that I represented over there, right? And then, expected value is the rational discount rate over there in your denominator. To the extent that all the information is reflected in the price already, it is possible to predict returns. It is impossible to predict return. Impossible to right for the future. Price moves like a random walk, okay? But the EMH does not say anything about which expected discounted rate, right? Discount rate you should use or expected cash flow to use. It's silent about it. Can you observe this guy? Future cash flow. Okay? Is it observable? Not really. You're just guessing it. You're just estimating it. And then discount rate. Yeah, do you have a true discount rate that solves everything? The answer is no. You might think that CAPM that you learned in your financial management is the is the ideal discount rate that you must use all the time, but that's not the case, right? That is just one starting point discount rate that you attempt. You will learn about it more thoroughly over here this week. So we are just guessing. And then those information about the company, right? What kind of information? Well, two kinds of information. One is cash flow related information, and the other is risk related information. Okay? All the finance news, financial world's news, can be degenerated into or summarized into two different kinds of news: cash flow news or discount rate news or risk news, right? That's it. Very simple world we are living in. Now, anyway, so three sets of information we can think about it. Yeah, those information either about cash flow or discount rate. Still, this information we can classify into three different kinds, which is past information, and then the second is a past plus publicly available information present right now, and then the third is everything, even including the information, the secrets in the company, right? And this leads us to progressively stronger notion of market efficiency, which is weak form market efficiency, which is the weakest form of claiming efficiency in the capital market. The second is semi-strong form market efficiency. And then the third is strong form efficiency. Weak form efficiency, it says all information in the past prices or past information is already incorporated into the price right now. Already. 이미 they are reflected in the price. That's an important part. Okay? Semi-strong form. It says all the information about not only past but also all public information is priced already in the market. Strong form is like all the secrets, not only those the past info and then the current public information, but also the insider information is already priced. Okay. Now, in other words, weak form market efficiency, past prices and volume information cannot predict future returns. Yeah, cannot? Why cannot? Because those information is already priced in the market. That's why. So let's look at it. So that means the technical analysis to make money, technical strategy, chartist strategies are wasting your time. Okay? Now, but technical analysis versus EMH, weak form, right? Let me discuss a little bit more about the technical analysis. It is really basic. It's based on your basic instinct about visual pattern recognition, right? Unintended consequence of natural selection. This is. What do you mean by that? If you think about the biological evolutionary process of human beings, right? We've been, for millions of years, we survived, our ancestors survived, as long as they had good visual pattern recognition in their brains, in their eyes, right? The ones who went to the hunting rabbits, right? If they are fast in recognizing the visual patterns of the rabbits as opposed to visual patterns of the grass or trees and then other things, right? Or the visual patterns of tigers, right? The guys who are faster in pattern recognition had a better chance of hunting the rabbits and avoiding those predators, right? So that kind of visual pattern recognition is strongly built into our brain, and then it pops up every situation. no matter how much it helps us or not, right? Helps us or not, we just have to justify ourselves by looking at any graphs or charts. We want to justify ourselves, and then, oh, that must be some cats going on, or some frogs we can justify, and that pattern, and we try to predict our pricing pattern. And then this kind of pattern recognition. Oh yeah, the guy is raising up their hands, and then it seems like the price is going up. Or nudge, right? The elephant seems like over there. All kinds of things happen. And then visual pattern recognition, technical analysis. Let's take an example over here, hypothetically. Let's say you found an interesting stock whose pricing pattern over the X month, I don't know how long it must have been going up and down, and then you are standing over here. Ding. Then what happens in your mind? Well, no matter how great you were in your high school math or not, right? You bring up all those sine, cosine functions and linear functions, and just all of a sudden you become expert in functional analysis, and then combine those functions, and then justify yourself. Oh, it seems like there is a resistance line where the stock price doesn't seem to go beyond this, and there seems to be like a support line below which the price doesn't seem to go below, right? And then it seems like up and downs, the frequency must be there, and based on those frequencies, it seems like in 1 month the price will hit over there, the target price. So given that my technical analysis, let's buy it. And what do? Hope and pray for 1 month until that price reaches up there. Okay, that's your technical or chartist strategy. And this kind of chartist strategy is not just common among Korean people, but it's ubiquitous all around the world. We are the world, right? We are the world. We are the children of visual pattern recognition. All the popular books about stock investment in the bookstores, right? They start with this kind of visual pattern recognition. But wishing you are the only smart guys, but you are not alone. Everybody is looking at the same graph, and then if your visual pattern recognition technique is correct, and everybody is correct on that, right? Then you are not the only one clicking that buy button, but all of the investors will click the buy button for the same security right now, so that demand shoots up, and then the price must go up to the target price instantaneously, right now, and then the price will start to do a random walk from now on, right? That's what the economist says based on your technical analysis idea. But the thing is, the price is right now over here, below over here, not over there, which means assuming that the market is weak form efficient, your technical analysis sucks. It does not work. That's the story here. Okay? Efficient market hypothesis rejects, weak form efficient market hypothesis rejects your technical analysis in this sense. All right? So they don't go together. Now, another thing about the technical analysis, right? Another thing against the technical analysis is this. The beauty is in the eyes of the beholders. You set resistance line and resistance line and support line like this by looking at this time period only, short time period. But if you expand the time horizon, you may find a totally different pattern. If you find this kind of patterns right now, then what would you infer? It seems like it's not a good buying time, but it's rather a selling time, because maybe the price will go down like that. Who knows, right? So it goes everywhere, the visual pattern recognition, right? So very problematic. So economists would say, forget about it. The market is weak form efficient. Now, testing weak form market efficiency, how would you do it? Well, weak form is about past return or past history, right? Does that predict future returns? So let's bring it to regression framework, regression. The X variable, explanatory variable, let's put the past return data as a predictor, and then see if it predicts the future return as a dependent variable. So what you see on the left-hand side is future return. Remember the subscript I should be your company. Each different company have different I's, right? And then T is a time subscript. Okay, time subscript. You have to familiarize this mathematical notation, right? Given that this is AI age, so you have to familiarize yourself. Now, dependent variable, this is your y-axis variable in your regression. X-axis variable, here it is, RIT minus 1. That is your stocks past return, one period before. How long should the period be? It could be 1 month, it could be 1 week, it could be 1 day, whatever. Define it in your way. Just be consistent in the length of period. Okay? And then and then run a regression, univariate regression in this sense, right? In a very simple manner. And then see if that coefficient gamma, okay, is different from 0. Okay? Your null hypothesis in your regression should be gamma being equal to 0. And then that if you cannot reject the null, that gamma equal to 0, then weak form market efficiency holds. And then Fama 1970 paper performs such test, and then he confirms that he cannot reject the null, that the gamma is 0. So weak form market efficiency holds true. Weekly basis, monthly basis, or that's what he tried. And then early test of generally supported weak form market efficiency, and then authors tried very elaborate trading rules, not only trends like that. So the conclusion was, even if abnormal returns could be forecast slightly using past prices, trading cost would probably eat up any profits. But there was a critique. Given that you're trying all this kind of trading patterns, trading rules by technical analysis, right? This kind of past returns, being able to predict it, right? The future return. That kind of things. Well, where would you get that idea? Well, from the technical analyst trading rules, right? Trading strategies. Well, if you are a technical analyst yourself, and if you have a very successful successful trading rules that you found, would you ever disclose it to your friends and families? No. You will keep it to your secret until the end, because you have to earn money out of it. So given that the most profitable trading rules are secret to themselves, how would my kind of economist, right, academicians will have a good idea about these, killer trading rules of technical analysis? So much so that you can test it. No way. Right? It's going to be a secret. So there is no way you can perfectly test the weak form market efficiency. That's the critique about Eugene Fama's method over there.